Today on Retiring Well with Michael Reese, we are talking about chasing returns.
What if getting higher returns ultimately led to making less money?
We'll demonstrate some very simple math how reducing volatility can greatly increase your bottom line.
Reducing volatility can often lead to more money.
And later in the show, we'll compare two portfolios with the same initial values that had grown at surprisingly different rates due to applying different investment strategies.
Losses hurt you more than gains help you. Consistency is what really matters.
All this and more on Retiring Well, starting right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I'm really excited about this week's show. We are talking about chasing returns, not chasing yields, chasing returns. This is really important because this is the kind of stuff that will either make or break your retirement. So you want to pay attention to this week's show. But of course, before we do that, like I do every week, I want to take a moment and share with you why we do this show. You see, I believe that your best is yet to come. Retirement, it's like 20 to 30 years of, yeah, I said it, 20 to 30 years of unemployment. We're all living longer, and you're expecting during that 20 to 30 years to do all the stuff that you wanted to do when you were working, but you just didn't have time. You want to spend your time pursuing what's meaningful to you, pursuing activities that provide fulfillment. But if you're going to do that, you've got to make smart choices with your money. You absolutely must make smart choices. And the problem is that most of the information you're getting from the financial media and from a lot of the financial advisors, it's not appropriate for that second half of your life. You know, they're giving you information about building, about growth and accumulation. But what's retirement about? Retirement is about protecting your principal, taking some income, and still growing over that period of 20 to 30 years. And that's where we come in. That's where we specialize. Because all the other financial media, growth and accumulation, for us, it's about that second half. Protect your portfolio, grow it a little bit, take some income, and that's the kind of information that we like to share. All right, got to ask you a question. I ask you this question every week. Have you gotten your complete retirement review yet? And in that review, what are we going to do? We're going to share, we're going to talk about retirement income planning. If retirement is like 20 to 30 years of unemployment, how are you going to take your assets and use them to generate income for that 20 to 30 years? And don't forget about inflation, it's going to play a role. What about a risk analysis? How much risk are you taking with your portfolio compared to how much risk do you want to take with your portfolio? Sometimes those are two different things. And of course, what's it costing you? I don't know any industry that hides what it charges you more than the financial industry. Why do they do that? Why can't they just tell you, hey, here's what it costs to work with us? Well, normally they're hiding because they don't want you to know what it costs. Well, what we do when you come in for your complete retirement review, we will show you. And of course, taxes. We run a tax analysis. I mean, think about it. What's your biggest, your highest, your largest tax liability? Probably your IRA, your 401k. What kind of conversations are you having with your advisors each year about transitioning away from those highly taxed assets into more tax advantaged assets like Roth IRAs? Are you doing Roth conversions each year? If you're not, why not? So when you come in for a complete retirement review, and all you got to do is call the number on the screen, we're going to help you take a look at all of these areas of planning so that you can live a very comfortable, safe, and secure retirement. Okay, what are we talking about this week? Chasing returns. Now, I've got a simple question for you. Why do you take risk with your portfolio? I mean, why? Why do you take risk with a portfolio? I mean, the answer is really pretty simple, isn't it? You take risk so you can get higher returns. Well, why do we want higher returns? Because, again, pretty simple, you want more money. Isn't that the name of the game with investing? You invest, you take risk, because at the end of the day, you want more money. But what if? What if just getting those higher returns, what if it doesn't lead to more money? What if getting higher returns ultimately led to making less money? And I know what you're thinking. You're thinking, well, how exactly is that possible? I don't really get it, right? Well, here's what we're going to do. We're going to go to the whiteboard, and I'm going to show you a very simple example of how that works. So when I head over here to the board, I want you to imagine the following. Imagine that you put your money in some type of investment, and in the very first year, you are up 50%. Now, think about that for a minute. And let's say you have $100,000. You're up 50% in the first year. How happy are you? I mean, you are thrilled to death, aren't you? You are a brilliant investor. And wow, I started with 100, I made 50% the first year. But then the second year comes along, and you know what goes up must also come down. Let's say the second year you lose 30. Well, if you do the math, you say, well, gee, on average, I'm up 20% in total. It was 2 years, so that's 10% per year on average. Well, let's do the math, though, and see what actually happened. You went from 100 plus 50, now you're at 150,000. But the next year you lost 30% of how much? Of 150,000. 30% of that number is minus 45,000. You ended up with $105,000. I mean, gosh, you could have put your money in an account where you averaged 3% 2 years in a row, and you'd have roughly 106. So what's the point? And we're going to explore this a little bit later in the second segment in a lot more detail. The point is this: reducing volatility can often lead to more money. And right after the break, I'm going to show you the secret as to why that is. Don't go away.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come. Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date that works best for you. September 1st or September 3rd at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today. You've always known how to enjoy life, to make every moment count, to explore and push the boundaries, to never stop growing. And with all this, you know your best is yet to come. Centennial Wealth Advisory. Portfolio stability, tax reduction strategies, lifetime income, financial security in any economy. Centennial Wealth Advisory. Your best is yet to come.
Welcome back. This week we're talking about chasing returns. In our last segment, I gave you a real simple little example where it talked about how a 10% average return and a 3% average return was basically the same thing. But of course, that was an exaggerated version. And so what I've done is I have on the screen here two portfolios. Portfolio 1, Portfolio 2. These are real world portfolios. And here is the point that we're going to focus on today. The point is simply this. We chase returns. We take on risks to get higher returns because that means it leads to more money. At least that's what we think. What I'm going to share with you today, what I'm going to teach you today, is that what leads to more money is not getting higher returns necessarily, it's in creating greater consistency. In other words, lower volatility. So let's take a look and see what we've got here. We have two portfolios. Portfolio number 1 here, you can see has a lot of ups and a lot of downs. We see when times are good, it's up 28, up 16, up 26, up 16, up 32. I mean, this thing is up high when times are good. But what about when times are not so good? Oh, down 12, down 22, down 37. So in other words, it either does really, really well or not so well, right? Meanwhile, Portfolio 2 here, it's a little more consistent. 6%, 5%, 8%. In fact, it's only got a couple of years that it's up in double digits, and when it is, it's barely, 10, 14, 13. But look at when it's down. It's only down 2, down 3. It's not down a lot. So in other words, this Portfolio 1, bigger ups, bigger downs. Portfolio 2, more steady Eddie. But at the end of the day, they both average 6%. They both have the same average return, exactly the same. And here's the question. Imagine that you put $1 million in Portfolio 1 and $1 million in Portfolio 2 at the beginning of this period, and you didn't touch the money. You just let it go. You just let it just kind of go. How much would you have at the end? And they would take two different paths, right? The first, Portfolio 1, it goes down, it goes up, it goes down, it goes up. Portfolio 2, it's a little more steady. But at the end of the day, you start with $1 million. You don't add money, you don't take any money out. You get the exact same average rate of return. Would it not make sense that you have the same number at the end of the day? Shouldn't you have the same number with the same average return? You would think. Well, let's find out. I'm going to walk over here to my little laptop, and I am going to Delete that thing, and here's what we got. Portfolio 1, you start with $1 million. After 15 years, you end with 1.8. Portfolio 2, you start with $1 million. After 15 years, you end up with, well, is that number right? 2.4. There's over $500,000 different here. It's $500,000 different. Why? Why? And I know what some of you are thinking, right? I know what some of you are thinking. You're thinking, oh, I know what's going on. Portfolio 1, it lost money early on. See how it was down 9 down? It lost money early on. Therefore, that's why they're not the same, because it lost a bunch of money before it made money. Well, I have some unfortunate news for you if that's what you think. It turns out that's not true. It turns out I could have taken these returns and reversed them, and I would have gotten the exact same outcome. The exact same outcome, and here's why. Think about it this way. What is 1 times 2 times 3? 1 times 2 times 3, it's 6, right? How much is 3 times 2 times 1? It's still 6. Well, how much is 2 times 1 times 3, or 2 times 3 times 1? It's always 6. The reason I bring that up is, in either case, it does not matter the order that these returns come. The order doesn't matter because no money's going in, no money's coming out. The order doesn't matter. The outcome is the same. The reason that the numbers are different is this. In the chase in Portfolio 1 to get higher returns, the person in Portfolio 1, they said, I'll take risk to get higher returns. In the chase to get higher returns, along the way, also they did get them. They also received bigger losses. And losses hurt you more than gains help you. Losses hurt you more than gains help you. When it comes to managing your portfolio, particularly after you're retired, or if you're getting near, if you're within, say, 5 years of retirement, or if you're into retirement, consistency is what really matters. And after the break, we're going to see what happens here when you start taking income. Don't go away.
You've worked hard for your money and your best is yet to come. You've reached a point where you don't put your money at risk anymore. The road ahead doesn't scare you because your money is secure and working for you. Centennial Wealth Advisory, portfolio stability, tax reduction strategies, lifetime income, financial security in any economy. Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date that works best for you. September 1st or September 3rd at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
Welcome back. This week we're talking about chasing returns, and we're exploring how do you make more money? Do you make more money in trying to get higher returns, or does it come from consistency? So far in our first example, we saw it came from consistency. But here's the thing. Once you get into retirement, when you're facing 20 to 30 years of unemployment, now you're taking money out of a portfolio. So that's when the rubber really hits the road. That's when stress comes onto the portfolio. So what I want to do now is I want to show these two portfolios, and here's what happens when you take money. So let's imagine you start with $1 million and you're thinking, yeah, I want to take some income. And maybe you're thinking, how about 5%, $50,000 a year? I mean, that doesn't seem like a lot. Let's start there. So let's go ahead and show the effect of taking $50,000 a year in distributions. So I'm just going to pop that number in here. Shazam. This is, our spreadsheet's fun. What happens on this first approach, you start with $1 million. You take $50,000 a year for 15 years. So you've taken $750,000 out of the portfolio. You got about 400 grand left. Now compare that to portfolio 2, the more consistent portfolio. You start with $1 million, you take your 50 grand a year out, totaling 750. What do you have left? Ooh, 1.2. Do you see a little difference there? Now, I like to have fun. You know I like to have fun. But I want to be serious for a minute. Because this is something, if you're close to retirement, if you're in retirement, this is the kind of thing you need to get in your gut. Because here's what I'm going to tell you. People call us all the time. They come into the office for their complete retirement review. One of the things we do is we analyze your portfolio. And it seems like all the time, well, at least 80% of the time, you think, this is what you think. You think you've got portfolio 2. But you know, when we run the analysis, you know what you really have 80% of the time? You've got portfolio 1. You think you've got 2, but you've got 1. And it's really important that you know which one you have. Because, think about it this way. We said retirement is like 20 to 30 years of unemployment. Imagine you do have portfolio 1. You think you've got 2, but you really have 1. You start your retirement, and off you go. And you're 15 years into retirement. You're halfway through retirement. And what do you learn? Holy cow, I started with $1 million, and I only have $400,000 left. And every night, when your head hits the pillow, every night, you know what you're thinking? You're thinking, man, I can't take that 50 grand anymore. I got to tighten my belt. I got to pull out less money. If I keep taking that 50,000, I'm going to run out of money. You know, when it's time to buy grandchildren presents, instead of buying them what you want to buy them, you're pinching pennies and you're buying them something else. Not what you really want to get, but the next thing. You want to go on that cruise, you don't have the money. Now compare that, though, to portfolio 2. What if you had your portfolio set up the way it should be set up? A portfolio that's designed for consistency. Now what happens? Started with $1 million. You took your income. You've got 1.2. Basically, what have you done? You've protected your principal. You've taken income. And you've grown it a little bit. Now when you want to buy a grandchild a present, what do? You just buy them what you want to buy them. You want to go on that cruise? No problem. You got the money. Folks, this is the difference between a retirement where you're running out of money and a retirement where you are comfortable financially for the rest of your lives. You want to make sure you have the right portfolio.
You don't walk into a doctor's office for some blanket prescription for whatever ails you. You expect individualized attention, a doctor who listens, and a treatment prescribed to meet your specific need. When it comes to your financial future, why expect anything less? If you would like an independent checkup from an independent advisor with access to hundreds of possible solutions to help you meet your goals, contact us today.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date that works best for you. September 1st or September 3rd at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
Let's recap what we talked about today. First, what happens? We're often taking on risk. Why? Because ultimately we want higher returns, which means in our minds we think that leads to more money. But what did we learn? Higher returns, it doesn't always lead to more money. Reducing volatility. Think of it this way, hitting a lot of singles and doubles. That's what leads to higher returns. You can live with single-digit return years. You can't live with the big losses that come along when you're also trying to get those high returns. And this is especially important if you're taking income. I want you to call the number on the screen. I want you to get your personalized complete retirement review. One in which we help you take a look at your income planning. But what are we talking about today? A risk analysis. Remember what I said? You think you've got portfolio 2. You've probably told your financial advisor, I don't want to lose money like I did in '08 again. I want to protect, I don't want to have that kind of downside ever again. But guess what? So you think you fixed the problem. But odds are you haven't. You call the number, you come in for your complete retirement review, we will tell you this is what you have. No ifs, ands, or buts. And we'll tell you what you're paying for it, right? All those hidden costs in the financial world, we will shine the light of truth on them. We'll share for you, here's exactly what you're paying, here's exactly what you've got. And we'll even compare it to what we do so you have something to compare it against. And of course, a tax analysis, you always want to pay the IRS as little as possible, as little as you are legally obligated to pay. All right, folks, that's our show this week. Hope you enjoyed it. Have a great weekend.